everyone, Faiz here. In this video, I'm going to teach you another trading strategy. It's quite similar to my other trading strategies that I have uploaded on this channel, but it has a little twist to it. So it only has like 3 rules. So guys, your strategy should be simple, okay? It should not be complex. It should be simple. It should have a few rules, and you should follow those rules like a robot, okay? No matter what. So this trading strategy has 3 rules. So we look for an ABC pattern liquidity sweep. Okay, so what is an ABC pattern? We have a move in one direction, and then we have the move in opposite direction, and then we have the third move in the same direction as the first move. So this is an ABC pattern right here, and the C leg takes out the high of the A leg. Okay, and similarly, if you're looking for longs, we have a move in one direction, right? And we have a move in the opposite direction, and then we have a move in the very first direction. Okay, and we sweep the low of the A leg if we want to go long. And in this scenario, if you want to go short, we look for this pattern, and we look for this pattern if you want to go long. I hope that is clear. If it isn't clear to you, you can go and watch my previous videos, and it's gonna be clear to you what is an ABC pattern. So once you have identified an ABC pattern liquidity sweep, now what is a liquidity sweep, right? So we have the A leg, we got the B leg, and when price sweeps the low of the A leg, right? This is called liquidity sweep. And in this example, in this diagram, you can see we have an A leg, we got the B leg, right? So this is a major swing high, and a lot of people have their eyes on this level. And when price sweeps this level, this is called ABC liquidity sweep. Okay, so we have an A leg, we got the B leg, and we got the C leg. The C leg is the leg that sweeps the liquidity, also known as the high of the A leg. I hope that's clear. And in this scenario, it would be the low of the A leg. So we look for the ABC pattern liquidity sweep, and the rule number 2 is we wait for market structure shift, change of character, whatever you want to call it, inside the range. Okay, so let me add this inside the range. Now what is a range, right? This line that I've drawn, right, on the high of the A leg, anything below this line is a range. Okay, anything below this line is a range, and I want the price to change the character or break the structure below this line. So if I make this a realistic diagram, let me draw it again. We got the A leg, right? And we got the B leg, right? And we will go, when we are about to sweep the high, we're gonna make structure like this. Okay, so we got this. Oops, got this. Oh my god, why is this so clumsy? And we got this, right? So sorry for this, guys. Okay, so when price the C leg sweeps the A leg, the high of the A leg, we should create some sort of structure. If there's no structure, right, then we don't look for trade. But if there's structure, we wait for price to come back down and break this structure. It could be a candle low, or it could be an actual low, right? So you should know how to identify a low. Okay, you should. I'm not going to teach you how to identify a low, because this is a very basic thing, guys. And if you don't know the basics, you should not be watching this video. Instead, you should be watching what is support and resistance, because these are anyways. Let's just keep on talking. So we wait for market structure shift, and we take our entry from the extreme fair value gap, and boom, we target the low of the B leg. Okay, this is our target level. We do not chase the price lower, we just target this level. So this would be your take profit level. So I got another clear demonstration. Whoops, where are we, man? Okay, so this is like a real life market, how it should look. Okay, so we would have a decent size, a big decent A leg, and then we would have a decent size B leg, and then we have a liquidity sweep, which is the C leg. Okay, so size matter, guys. Size matters, okay? That's what she said. So you can see we have an A leg, which is quite big. It doesn't need to be that big, okay? It just have to be a decent size, and I'm going to tell you what is a decent size. And then we have a B leg, and then we got the C leg. And when the price is going for a C leg, it should create structure like this, okay, inside the range. And when it sweeps the liquidity, we wait for market structure shift. Now price should not go this higher, okay? It should not create something like this and keep on going up. And then when it comes back, no, this is not valid, okay? Because price might go and create another ABC pattern, right? By literally sweeping this high. So make sure price doesn't go that high. You just wanna see, this is the actual, it can go this higher, right? Or it could go, this is the max length, this somewhere around here. And then it should come back and break the structure, which would be this. And we take our entry here and we target this level. And we're looking at the 5 minute time frame, and we should only be looking at one time frame in this trading strategy. And let's go here, and I'll try to give you guys an example if I can find. Okay, there you go. So as you can see, we have this A, B, C pattern, right? So if I mark out the high of the A leg, we sweep out the liquidity, and we have this structure that was created. As you can see, that was created before price swept the liquidity, right? So we should be only looking for this level. However, you can see the low of the B leg was already taken before our entry. So this setup becomes invalid, okay? However, you can see that we still have a valid ABC structure. So we still got this A, B, and then we get the C leg, okay? So it can continue. So we got the high of the A leg, we sweep this level, and then we got this low here, right? As you can see, we break the low, and this structure, as you can see, was created before price touched this line or swept the liquidity, okay? So please notice, please listen to what I'm saying, okay? This is very important. So when you draw out the high of the A leg or low of the B or low of the A leg, depends on what trade you're taking. If you're taking long or short, you mark out, let's say for in this example, you mark out the high, right? If price goes up, touches this line, and then comes back, and then breaks up again to sweep the liquidity, then that structure is not valid. However, if price creates, so we can see we got the higher high, higher low, higher high, higher low, higher high, higher low, higher high, low, and then we got a liquidity sweep. Before price swept the liquidity, we created this structure, and this is a valid structure for me. So after the liquidity sweep, we wait for market structure shift, and as you can see, we have market structure shift at around this level, and we look for fair value gap. So there's no fair value gap here or imbalance, okay? But you can see that we have this fair value gap right around here, okay? So if I mark the fair value gap right here, and I take my entry, and I put, now where to put your stop loss, you could either put it at the high, or you could put it at the body of the candle, okay? You could put it at the body of the candle. A little higher would be fine. So, and what is your take profit level? The low of the B leg. So this is the low of the B leg, right? So if I see this, you can see that we hit the take profit level, and then we instantly reversed, guys. So look at the accuracy of this thing. It's nuts. Okay, so I'm gonna give you guys a couple of more examples, and then I'll end the video. Guys, so here's an example number 2. As you can see, we have the A leg, we got the B leg, and now we're about to make a C leg, right? So what you do is you mark out the low of the A leg when you're looking for a long position. So we wait for liquidity sweep, and boom, we swept the liquidity. Now, as you can see, we made this structure, right? We made the structure before liquidity sweep. So if I play this through, we should break this structure, okay? And there you go, we broke this structure, as you can see, and we want to wait for a candle close above this high. We should not consider the wicks, we should consider the bodies, okay? And as you can see, we have this huge fair value gap, okay? Now there are two things that you can do when there is a big fair value gap, okay? And if you don't know what fair value gaps are, you can search it up on YouTube, and there are a lot of videos on it, okay? So you got this big fair value gap. Now, as a normal person, okay, you can take your entry from this big fair value gap. But if you wanna, if the fair value gap is big and you wanna increase your risk to reward, you can use the Fibonacci level from the start of the fair value gap to the end of the fair value gap, right? And then you can take your entry from the 50%, which is right here, and then you can put your stop loss below the candle body, or below this level, which would be this. So I would put it here, and if I close the fib now, where should be our take profit level? It is right here, the high of the B leg, okay? And if I go here, this would be 3.97. But if we took our entry from the end of the fair value gap, we would have a 2.37 risk reward trade. So let's go with that, okay? So we already have our entry, but let's see how this plays out. And boom, we came back, mitigated this auto block right here, and we just pushed back up. So you can see how well this strategy works, guys. If you took your entry from the 50% level and you had your stop loss here, and you did this would have been a almost 4 risk reward trade, guys. So a very simple and easy trading strategy. You can see that we waited for the change of character inside the range, okay? So let me draw this out. This doesn't matter. This structure doesn't matter. This structure doesn't matter, okay? Only this structure matters because it is above the range line. So I'm gonna give you guys one more example, and I'm gonna end the video. So here's another example. So as you can see, we are making A leg, we got the B leg, and then we got the C leg here. We then came back down. But what we can do now is that we can consider this as an A leg, then we can consider this as a B leg, and then we got a C leg that sweeps the high of the A leg, okay? So as you can see, when we draw out the high of the A leg, the C leg swept the liquidity, and then as you can see, price created this structure right around here before price went up and swept the liquidity or high of the A leg. And then we broke this structure, which is right around here, and then we left a fair value gap, as you can see right here. This is the fair value gap, right? And if I take my entry from this level, you can see that we got a entry here, and my stop loss would go right above the candle here, okay? And we target the low of the B leg, which is this. So this was an insane 1 to 12 risk to reward trade, guys. This is absolutely insane. Now, of course, you should not be holding your trade like this. You should be taking partials along the way. So for example, I would take my first partial here when this structure breaks, and I would go break even when this structure breaks, okay? I would put my stop loss at break even, and then I would definitely take some partials here in this fair value gap level, and then I would definitely take a very little bit of profit here, and then I would most probably just wait for price to take this level out, because price has come so close to this significant low. So there is like 90% chance that's gonna sweep out this level. And look at the accuracy, guys. What I teach on this channel is not a joke, okay? It actually works. It has a set of rules, and you follow them strictly. Now look, when price hit the take profit level, it just reversed, okay? It just reversed back. So it's just crazy how this thing works. And it took me a long time to backtesting, and I just found this crazy thing, right? So hopefully it's gonna work for you as well. I want you guys to backtest. Now I'm gonna give you another trick that you can use to increase your win rate. So let's suppose that you are looking for these structures on the 5-minute time frame. You can go on the higher time frame and you can look for overall market structure. So if the market is in a bearish trend, right? Let's say on the 4-hour time frame, if it is bearish, you only take short positions. And where do you take short positions? So let's say on the 4-hour time frame, right, we have this bearish market structure. So we create this level and then we break this low. So this is a 4-hour time frame structure, which is bearish, right? Now you use your fib at the high, all right, the lower high and the lower low, and you wait for price to go back above the 50% Fibonacci, right? When price goes above the 50% Fibonacci, then you look for an ABC pattern on the 5-minute time frame, okay? And on the 5-minute time frame, it's going to look something like this. And once that happens, you take your entry from there, and boom. Okay, so what is the reasoning behind this thing? So anything above the 0.5 level is considered premium, okay, and anything below the 50 level is considered discount if you're looking for shorts, as of course, okay. And let me give you another example. So let's say the market structure, the overall market structure on the high time frame, which is 4 hours, is bullish. So we got this type of structure, right? So what you want to do is you want to draw out your Fibonacci level from the low to the top, and of course you cannot predict the high. So you will keep on moving your Fibonacci till the price starts to retrace, right? So let's say price starts to retrace from here. When the price comes back below the 0.5 level Fibonacci, you can then look for a bullish ABC pattern, which would be something like this on the smaller time frame, of course. And then you would take your entry and it can go up. Okay, so this is something that you can add in this trading strategy, but it is optional. Okay, it is optional, but it's going to increase your win rate by, I would say, 5 to 10%, or sometimes even more, depending on your market condition. So if you don't know what I'm talking about the Fibonacci levels, you can go to YouTube and search for Fibonacci premium and discount zones, and you're going to learn that stuff. So anyways, guys, I'm going to end this video now. Hope this was clear and easy strategy. I want you guys to backtest this strategy as much as possible, and try and find your own, little things that you can add up to this strategy and improve it. Anyways, guys, I am out. If you want to learn more strategies, you can go down into the description and join my mentorship program, where I teach 9 trading strategies, and of course those strategies are profitable, and I would just not put them there if they were not. So but this is not necessary. I'm going to teach you a lot of stuff for free on YouTube. Anyways, goodbye, take care, God bless you.